Again, I will say the hint I will give you is you need to be tracking how many shares outstanding there are after each transaction. Okay, because you're going to see here, you're going to pay a cash dividend, you're going to have a stock split, that's going to increase the number of shares. Then you have a stock dividend, so that's going to be based on the new after split stock count. You're going to purchase treasury stock, so that's going to reduce the share count. So just make sure you're tracking how many shares are outstanding at every given moment. Okay, so we declared a cash dividend on both the preferred and the common stock. Okay, so we're going to have cash dividend because now we learned that there's not just one type of dividend. There's cash dividends and there's stock dividends. So we're just going to clarify that this dividend is a cash dividend. And there, we're going to have two dividends payable. Dividend payable for preferred, pref, dividend payable for common. So we have the accounts that we need. Now we just need to figure out the amounts. So the preferred return is going to be 6%. Par value is $95, and there's 1,000 shares outstanding. So we could just do 0.06 times $95 a share times 1,000 shares. And then the other one is 55 cents per share on 90,000 shares. So that's just 55 times 90,000. And then you just add them up to get the total dividend that you got to pay. And then the second transaction on February 15th is we pay the cash transaction. So again, this was January 16th. On February 16th, we're now going to distribute the cash. So these two are going to go to zero. We're going to credit cash, 55,200. And the common is this. And this one is this. Okay, so now these dividends payable are now zero. And we've paid our cash dividends to our respective classes of equity. Okay, stock split, June 10th. Do I need to do anything for this? Any journal entry required? No, no journal entry. But what I want to do is make sure that I know that I have how many shares of outstanding now. How many shares of common stock are there? Well, there were 90,000. There's now, it's 2 for 1. So for every one share, there's now 2. So it's 180,000 of $5 par value stock. Because it was $10 par value. Now we have, so I'm just going to put a note here, 180,000 shares, $5 par value outstanding. So that's going to be relevant because now in the next journal entry, we're going to pay a stock dividend on 30% of the outstanding common stock. Okay, so declared a 30% stock dividend on common stock. The market value of common stock per share is $12. Now, this is a large stock dividend, okay? We do not need to use the market value. That would have been relevant in our journal entry if we were doing a small stock dividend. But in this case, since we're doing a large stock dividend, we're just going to use the par value, okay? Now, the large versus small stock dividend, the accounting difference is just how much we're attributing to the value of the dividend. But again, it doesn't really matter because we're just moving balances around. It's not going to, in the end, change the value of the total equity. We could have used $1 for this stock dividend value, okay? And it would just move a different amount. So in this case, we're just going to follow the convention. We're going to use the par value, not this market value per share, because it's a large stock dividend, okay? So we have 180,000 shares outstanding, and it's a $5 par value. So one way you can do it is to figure out the value of the stock dividend. You basically can do 30% times 180,000. That's the number of new shares that we're going to create, times, in this case, again, since it's a large stock dividend, we're going to use the par value, not the market value. Okay, so it's $5 par value. Okay, so this is going to be basically stock dividend, stock, right? Because we had dividend cash here. This is stock dividend. And we're going to have basically common stock distributable, dividend distributable. And that's the value. Okay, so that's what we do when we declare this on July 30th. Now we're going to actually pay it out. We're going to create those shares. So we're going to basically debit this, and we're going to issue the shares, common stock, $5 par value. And if you wanted to put how many shares that you're creating, the number of shares that we're creating is, again, 180,000 times 30%. So 540,000. That's the number of new shares. So I can maybe put that in parentheses. 54,000 new shares. And again, these 54,000 shares will be distributed to the existing shareholders in proportion to their percentage ownership in the business. Okay, so this is August 15th. So now we're going to have some treasury stock transactions. So we purchased 3,000 shares of treasury stock at $10 a share. So 3,000 shares times $10 a share. So that's going to be $30,000 worth of treasury stock that we're buying, and we're paying cash for that. Now we're selling 1,500 of those back at $11. So we're going to have that gain, right? That paid in capital from treasury stock transactions, because we're having $1 per share profit here. So in order to do that, we know that we have cash coming in the door, and that's going to be equal to the 1,500 shares times $11 a share that we're kind of reselling the shares for to some investor, to someone in the market. We're going to conduct our transaction for the treasury stock account at $10 per share. That's our cost basis. So that's how much we're going to credit treasury stock transaction, or treasury stock account. And we're going to have this little gain of $1,500. That's going to go into paid in capital from treasury stock transaction. Okay. And now we have a sales transaction of 700 at $7 a share. So we're going to be receiving cash, $7 a share times 700 shares. Our treasury stock account is going to be transacted at 700 shares times $10, which is, again, our cost basis. And now we can see we are going to have to take some debit. Okay, so we can't just do this, because we only have $1,500 in our little piggy bank here. Okay, so we're going to have to split this up. We're going to have to do this. The max we can do this is 1,500, right? Because now this is fully offset with this debit. Now that account is zero. And the rest of it we're going to take from retained earnings. Okay, so it's going to be 7,000 minus this, minus this. Okay, so now our journal entry debits and credits balance. We fully zeroed out this account. We lost back all of the money that we gained from the first sales transaction, plus a little more, which we see this retained earnings debit. But we still have some shares, right? Because we've bought We bought 3,000, but we've only sold back 2,200. So how many shares do we still have? We still own 800 shares, right? 3,000 minus 1,500 minus 700 is 800. So this is going to affect how many shares are outstanding. Okay, so how many shares are outstanding? Okay, so let's do the math. Okay, so 90,000 we start with, starting 2-for-1 stock split. We have this times 2. Okay, then we had a 30% stock dividend. So I can just do this times 1.3 is going to give me 130%, which is just the number of shares outstanding plus the 30% that we're adding. Okay. And then we had some treasury stock transactions that basically net reduced this by 800. Do we agree? Because I first bought back 3,000, but then I sold some back into the market. So the net result of that is only 800 that I still have taken off the market. Okay, so I just reduced this by 800 shares. And so this is the number of outstanding shares. Okay, the number of issued shares is this, 234,000. That's the total number that were floating around before the treasury stock transactions. Okay, so I can now populate part of this. Okay, so actually it's giving me some information here. 400,000 shares of common stock were authorized. Okay, so if I go here, I can now start filling this in. The par value is $5. I know that from the original 10, and then after the stock split, it goes to 5. 400,000 are authorized. The number of issued was 234,000. And the number of outstanding is, I think, 233,200. I think. Let's see. Let me go see. Yeah, 200. So this is number that were issued. This is the number that are outstanding, which is basically the number of issued minus how many I have in treasury stock. So this is now how it's going to read. Okay, so I have all the share information right. Now the question is, what is the dollar amount? Okay, so there's some additional information here. It says both preferred and common stock were issued at par. Okay, so I can see that initially these 90,000 shares of common were issued at $10 of par value. So if I looked at my balance initially for common stock, it's going to start off at 900,000 because it's telling me I issued them at par. Okay, so this is the dollar amount that's first there. Did I do anything after that? Let's look. No common stock. Right here, I have this. This is the only thing that's now affecting common stock. Another credit of 270,000. Okay, nothing else that I did is affecting common stock except for this common stock, this stock dividend. Does everyone agree with that? We're good? Okay, so the total here, wait, 1,170,000. So now I have the dollar amount here, 1,170,000. Okay. For preferred, I think it said the number of authorized was 4,000, and the number of outstanding is 1,000, and that didn't change. We didn't do any preferred stock dividends or anything. And again, 4,000 is from here. 400 shares authorized, and we know that 1,000 shares are outstanding from that first journal entry. Okay, and then the value of this again is just 1,000 shares, and they were issued at par value, $95. So now we can add these up to get our total paid in capital. Okay, and then it also said retained earnings balance is $2,020,000. It's just telling us the ending balance here. Treasury stock. Okay, what is the value that I have in my treasury stock? How many shares did I have? 800. What was my cost basis? $10 a share. So it's going to be 800 times $10 a share. Now, is treasury stock, should that be a positive or a negative? Is it taking away or is it contributing to equity? It's a debit balance, okay? That means it's taking away from equity. This has to be a reduction, okay? So now we could add this all up. So yeah, this is going to be tricky. This is going to be the hardest part of the homework, is actually compiling this part of the balance sheet. Okay, because you have to keep track of the number of shares outstanding. You got to see how many shares you have in treasury stock, what is the cost basis. If you did the stock split before a stock dividend versus after, it will change the share count. So all this stuff you're going to have to kind of be tracking in order to properly populate all this information.